The greatest trade ever was made by an unknown, small-time hedge fund manager who used an obscure, barely heard of strategy. His bet made nearly $20 billion in 2 years. The only other trades that come close are David Tepper's $7 billion financial crisis recovery bet and George Soros's $2 billion bet against the pound. John Paulson had no experience in the industry he bet on, yet he won. And this is how he did it. Welcome to Alux, the place where future billionaires come to get inspired. Now, John Paulson's $20 billion trade, it came from a contrarian investment. Now, contrarian investing says the market is like a madman and you shouldn't pay attention to what it's saying or doing. It says you'll perform better when you move against what most people believe is true because people follow each other, even when they think they're following data. And when they follow each other, they get caught up swinging between euphoria and panic. This swing creates mispricing, so assets get overvalued or undervalued compared to their true worth. From 2000 to 2006, the US market was in this euphoric state. Usually, housing prices increase between 3 to 5% per year, right? But this time it was going up by 10% per year. Now, this was happening for two reasons. First of all, banks were handing out credit and mortgages to people who couldn't afford it, so more people were buying homes. Second of all, the credit rating agencies who looked at these mortgage packages gave them AAA ratings, so everything looked great. One day, from his office on Madison Avenue in New York, John Paulson notices a weird trend in the housing market. Now, one thing you've got to know about loans and mortgages here is that there are two categories of people who request them. One, prime borrowers, and two, subprime borrowers. Now, prime borrowers are financially stable people with good credit, usually above 660, and subprime is below prime. These are people with credit scores under 620. So when banks hand out loans to people with poor credit histories or low income, anything that makes them high-risk borrowers, it's called subprime lending. So to offset the bad credit scores of subprime borrowers, these loans have higher interest rates and more aggressive terms, like prepayment penalties. So John noticed that there was a massive increase in the number of subprime loans. Like from 2000 to 2006, subprime loans, the loans given to these people with bad credit, they tripled. And the amount of money these people owed on their homes doubled from $4.8 trillion to $9.8 trillion. Now, John knows that he doesn't have much experience with real estate, so he hires an analyst, Paolo Pellegrini, to help him do a deeper dive. So they find out that because the banks were the ones in charge of approving the loans, and they were then selling the loans to investors and getting their money back immediately, they didn't really care who they approved. Now, traditionally, banks made money by lending responsibly and collecting monthly payments over time directly from the consumer. The consumer would go in and ask for a loan, the bank would then approve or deny that loan, and the customer would pay the bank back. But without the separation, instead of the bank holding on to that loan for 30 years, it could sell it to Wall Street and immediately make the money back. Cheaper mortgages mean more people are coming in. And getting the money back immediately means more money coming in immediately for the bank. So they were just approving everyone and encouraging people to take offers they would never be able to pay off. And they could use this loophole for two main reasons. So in the late 1990s, US Congress got rid of a law that used to keep regular banks and investment banks separate. This change allowed big banks to both give out loans and then turn those loans into investments they could sell to others. And post 9/11, the Federal Reserve cut interest rates to stimulate the uncertain economy, which made mortgages much cheaper. So John and Paolo, they saw that the banks were using complicated CDOs to turn the loans into investments. A CDO bundles together a load of debt, like mortgages, corporate loans, and bonds, into one big pool and then sells pieces of that pool to investors. Like, imagine you're making a smoothie or something. Your ingredients are all old and kinda spoiled, but because there are so many in there, nobody notices at first. So in the CDO world, let's say apples are home mortgages, bananas are corporate loans, and berries are student loans, and on it goes. You throw all of that fruit in and blend it all into one giant smoothie. That is your CDO. Then you pour that smoothie into different cups. In your CDO world, these cups are called tranches, French for slices. Then, Wall Street would sell these loans to investors who were promised a stream of monthly income from people paying their mortgages. And these investors used pension funds, insurance companies, hedge funds, and other government funds to buy these loans. So they never used their money, really. Now, the fruit inside of this smoothie is clearly rotten, and yet banks keep blending, and Wall Street keeps buying, and investors keep using other people's money to buy slices from Wall Street. Rating agencies, they're the watchdogs that look into these issues and stop them from happening. But when John and Paolo looked at what the rating agencies were saying about these CDOs, they found that they were giving them AAA ratings. And that is when they realized that the matter of the market collapsing was a when, not an if. And so John, well, he began hedging his bets. This kind of risk was unusual for him. He's a smart guy, he always has been. But he kind of lost his way a little bit post-college. He graduated top of his class at New York University and in the top 5% at Harvard Business School. After graduating, he went into management consulting, where he stayed for a good few years, partying it up and living the good life. Eventually, though, he decides he'd rather run his own thing, so he starts his own hedge fund, Paulson & Co., back in 1994. But no clients came in. Now, at this point in your career, when you look around and you see everybody else soaring and you're still running to catch up, it can feel kind of like a WTF am I even doing here, okay? It is so easy to get caught up in this self-doubt mindset, and the irony is that the longer you're stuck here, the harder it is to get out, right? So how do you do it? Well, Paulson had his dad, but not everybody has that support, which is why we built this, okay? We built the Alux app, your personal support system. It starts with a routine where we send you daily lessons on how to build and balance your money and life, and then you step it up with collections and courses from experts that focus on a specific area that you need to work on. You also get a personal progress report and built-in journal. These tools have helped hundreds of thousands of Aluxers, and some of them have even scaled up to 1 million and built good, strong relationships while they were at it. And if this sounds like something that would absolutely change your life, we agree. So we're giving you a 25% off discount. Just download the app and scan this QR code and you're good to go. Just like John, you could be one step away from the biggest payday of your life, and all you need to do is get some support and guidance. Now, back to our story, okay? So in Gregory Zuckerman's book, The Greatest Trade Ever, Paulson talks about how this was actually a lonely, demoralizing period of his life. He was constantly rejected, and he felt like he'd missed his chance. He said that when he wanted to give up, 2 people motivated him to keep on going: his dad and Winston Churchill. It was Churchill's 1941 Never Give In commencement speech that pushed John to keep on going. Now, at the time of Churchill's speech, Britain was basically fighting alone against Nazi Germany. He said, "This is the lesson. Never give in, never give in, never, 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 never in nothing. Great or small, large or petty, never give in except to convictions of honor and good sense. Never yield to force, never yield to the apparently overwhelming might of the enemy." Paulson started his firm with $2 million and 1 employee. It took them a year to get their first client, and although he was managing tens of millions, his funds were only netting his clients about 5% per year, well under the average 9% of other funds. But that all changed when he started buying credit default swaps on those subprime mortgage loans. So at the time, most investors had never heard of credit default swaps. Paulson had only heard about them because he'd done such a deep dive into why there was such a massive increase in subprime mortgages. So a credit default swap is like insurance on a bond. If someone can't pay the mortgage, the credit default swap pays it out. Just like insurance, you pay a small monthly premium for the CDS. However, you can buy a credit default swap without actually owning a bond. Now, normally, insurance is something you buy to protect your own stuff, but a CDS is different. You don't have to own the loan or the bond to buy one. You're just making a bet that it will fail. It's like buying fire insurance on someone else's house because you know that it's gonna burn down eventually. So he bought CDS contracts from big financial companies like AIG and investment banks. He paid them regular fees like you would pay for insurance. These companies agreed that if the mortgage bonds failed, they would pay him. So when the housing market collapsed and these bonds lost value, the companies that sold him the CDS had to pay him billions of dollars, even though he never owned the original mortgage bonds. John didn't short the housing market directly. He just bought insurance for if or when it fails. CDS contracts were mainly used by big banks as an insurance to protect themselves in cases of a company not paying back a loan. Almost nobody was using them to bet against mortgage-backed securities, investments made from bundles of home loans, because everybody believed the housing market was safe. People thought home prices would always go up and that mortgages were one of the safest places to put money. CDS contracts weren't traded on the stock market. They were sold privately in deals between banks and investment firms, so it was nearly impossible to track. The contracts were tied to massive pools of subprime mortgages, so even the firms and banks selling the CDS didn't fully understand just how much they would have to pay out if those mortgages started to fail. So Paulson was able to spend a small amount of money to buy CDS. And when those specific mortgage bonds lost value because people stopped paying their home loans, Paulson would get paid out. He didn't need the whole housing market to collapse, he just needed a large number of bad loans inside those mortgage bonds to fail. And since nobody believed this would ever happen, the CDS contracts were really cheap. Other investors who thought the housing market would crash made money by betting that home prices would fall. But those kinds of bets only made money after the crash had already started. But Paulson, he directly bet against the bonds made from risky home loans, and those subprime mortgages were the first to collapse. So his bet paid off sooner than everybody else. He was in and out with his billions while everyone else was still trying to understand how deep this crisis went. Other investors also made a ton of money, like Michael Burry, who made $700 million. But he only started betting aggressively a little later, and by then, the people meant to pay out those bets were already struggling to keep the lights on. Paulson's exit was perfectly timed just before the full crash, so he locked in profits before CDS premiums became too expensive and crowded. In 2007 alone, he made $15 billion for his fund, and he personally earned $4 billion, the largest one-year payout in hedge fund history. Now, housing prices had never gone down nationwide in America before. It happened to specific states, sure, but even to the most seasoned investors, this kind of collapse did not seem possible. Too big to fail, is what they said. So John's all-in bet seemed absurd, okay? Unheard of, contrary to the belief of what was happening. And he had no experience with the real estate industry. Had he been wrong, it would have destroyed his reputation and his career. But the ability to go against the crowd is what makes contrarian investing a mindset rather than a strategy. With a strategy, you've got a neat, set plan you can follow. If X happens, do Y. But a mindset is how you approach decisions, especially under pressure. Contrarian investors don't just make different moves. They think differently. They're comfortable being uncomfortable. They don't need other people to agree with them to feel confident. No, that's why being a true contrarian is way harder than it sounds. It takes experience, emotional control, and a strong belief in your point of view, even when the crowd says you're wrong. 99% of the world can't help but follow the crowd. It's like there's this desperate need not to be left behind, right? Even if it means losing because the crowd is running toward nothing. Warren Buffett is a great example, although he used a more focused version of this idea. The psychology of 99% of the world is that we can't help but get caught up in the wave. Between 1977 and 2012, David Draymond, a value investor who focused on market psychology, wrote 5 books on contrarian investment strategies. So in his 4th book, he gives a series of quotes to show how even the most educated experts have failed time and time again to predict massive tech, economic, and societal shifts. In 1977, just years before computers became a household essential, Ken Olsen, the founder of Digital Equipment Corporation, said, "There is no reason anyone would want a computer in their home." In 1903, the president of Michigan Savings Bank warned a lawyer not to invest in Henry Ford's new auto company. Apparently, he said, "The horse is here to stay, but the automobile is only a novelty, a fad." So Draymond shows that no matter how confident or clever an expert's opinion might be, it usually fails when trying to predict complex systems, and this is especially true in markets. The more widely shared a belief is, like the fact that housing prices will always go up or the internet is a bubble, the more dangerous it becomes. When people just accept a belief as a fact, it stops being questioned. Everyone begins to act on that belief as if it were a fact, and it creates a feedback loop where people buy into the idea, which pushes the prices higher or lower and makes the belief seem even more true. But markets don't move based on certainty. It moves on risk, behavior, and surprise. Certainty is always priced into the market, so prices don't change when everything is going how people predicted it would. It just stays there, safe and sound. Prices change when something new happens. If everyone already believes the company will do well, even great results might not move that stock. But if a company everyone had written off suddenly performs, that surprise can trigger a rally. So when a widely accepted belief turns out to be wrong, the fallout is massive because it's like everyone was sitting on the same platform. So now there's nobody left on the other side of the trade and people panic at the same time. Draymond says that when everyone is moving to the same platform or running away from the same platform, you should be going in the opposite direction because that is where the profit is. The psychological foundation of contrarian investing, and exactly what John Paulson did, is to ignore the hype. Don't trust what everyone else is doing and rely on your own real-world observations, not models or assumptions. Like every investor, you've probably heard of contrarian strategy and mindset, but how often have you actually followed it and stuck to it? Don't feel bad if you get caught up in the emotional swings, okay? Resisting that swing is literally resisting the very psychology and makeup of how you operate. It's psychologically uncomfortable. It means you have to buy stocks everyone else hates. You have to invest even when the news is bad. Hold your ground when others panic. As humans, we're wired to follow the crowd, not to go against it. So when a stock is falling or a market is crashing, your fear kicks in, right? And of course, when you see other people making money, your FOMO takes over. No matter how well you understand contrarian investing, fighting against fear, doubt, and social pressure is a whole other ballgame. When you enter into something early and you're actually wrong at first, and you're there all alone and scared, it's painful, right? It's natural to want to run back. And that's what keeps most people from sticking with it, never mind going all in on it. John Paulson, despite having no experience in real estate, unlike Michael Burry, and no insider knowledge, like Deutsche Bank, still went all in. He went all in even when the rest of the world was on a completely different platform. And then he watched as that platform slowly started taking strain. And just before it collapsed and people came running onto his side, he got out. His lack of knowledge in the industry, his ability to spot something that was awry, the realization that he needed an expert to help him dig into what was happening, and his determination to understand it. His resolve to go all in even when everyone else was doing something totally different. His timing of getting in early and recognizing when the tide was about to shift. That is what made this trade the greatest of all time. Humility plus talent plus confidence plus self-belief plus instinct equals $20 billion in this case. We'd say it was worth honing those skills. What do you think? Now, Alux, if you like this video, we've got some more for you, okay? Draymond always said that experts can be wrong, so what about the question, will the stock market always go up? Go watch our video on that and see for yourself. And if you're ready to go even deeper into your wealth building journey, then the Alux app is ready for you too. Scan that QR code to get the discount. I'll be right there with you on the inside. Until next time, my friend, take care.